Welcome to the deep dive. So today we're going to really zoom in on generating passive income, specifically dividend stocks that pay out monthly.
Right, monthly income. That's the goal for a lot of folks.
Exactly. And our guy here is a fresh piece from The Motley Fool, just out yesterday, May 5th, 2025. We're going to try and, pull out the key stuff on their top 3 picks.
Yeah, the Motley Fool, they've been around a long time, since '93, offering all sorts of investment advice, websites, podcasts, premium stuff. They're pretty well known in this space.
For sure. So if you're listening and want some quick ideas for maybe a more steady income stream without getting totally bogged down in research, well, this is for you. We're zeroing in on Agree Realty, EPR Properties, and STAG Industrial. High-yield dividends, according to the Fool.
Let's do it. Where should we start? Agree Realty.
Yeah, let's kick off with Agree Realty. Ticker's ADC, right?
That's the one. Okay, so Agree, they've got a yield, it's around 4% based on the article. Yeah. And the big thing, right, for people wanting income, they pay monthly.
Yeah, that monthly payout, that's huge, isn't it? Most stocks are quarterly.
Makes a difference for budgeting, for sure.
And that 4% yield, how does that stack up? The article compared it to the S&P 500.
Right. It's more than double. The S&P average is, less than 1.5% right now, so
yeah,
quite a bit higher.
Okay, double. So practically speaking, what does that mean? Like if you put in, say, $1,000...
The article breaks it down. $1,000 investment, you'd be looking at about $3.33 coming in each month.
$3.33 a month, so $40 a year, roughly.
And per thousand invested. Gives you a sense of the scale.
Okay. So what are they actually investing in to generate that income? What's Agree's business?
So what Agree actually does is invest in retail properties. Yeah. Mostly single-tenant spots.
Single tenant, okay.
And the structure is mainly net leases. That's like almost 90% of their rent. The rest, about 10%, comes from ground leases.
Okay. Net leases, ground leases, we hear those terms. What's the deal with those? Quickly, why are they good for?
I agree. Well, with a net lease, the tenant usually pays for almost everything: taxes, insurance, maintenance on top of the rent.
Ah, so less cost for Agree then.
Exactly. And ground leases are just long-term deals for the land itself. Both models mean, pretty predictable income for Carrick. Agree. Less fluctuation.
Predictable income. Makes sense for paying out regular dividends. Who are the tenants? Are they solid companies?
Seems like it. The Fool article says they really focus on partners who are financially strong in resilient sectors.
Like what kind of sectors?
Think grocery stores, home improvement places, tire and auto service centers, stuff people need regardless of the economy, generally.
Right, essentials.
And get this, over 68% of their tenants have investment-grade credit ratings.
Oh, wow. So very low risk of default, basically.
Yeah, that's what an investment-grade rating implies. It suggests stability.
So stable tenants, stable leases. What about Agree's own finances? Can they keep paying, maybe even grow the dividend?
Looks pretty good there, too. Their payout ratio, it's pretty low for a REIT, actually. Something like 72% of their adjusted funds from operations, their FFO, last quarter.
FFO. Remind us what that is again.
It's kind of the key cash flow metric for REITs, similar to earnings per share for regular companies.
Yeah.
So 72% payout means they keep about 28% of that cash.
Okay, so what do they do with that leftover cash?
They reinvest it, buy more properties, grow the portfolio. Which, should lead to more income down the road. Plus, the article mentions a conservative balance sheet.
And more income could mean higher dividends eventually.
That's the idea. And they have a history here. The article points to a 5.5% compound annual growth rate for the dividend over the past decade.
5.5% growth per year for 10 years. That's pretty consistent.
Yeah, it's a follow track record.
Okay, so summing up Agree Realty for you listening, looks like stable retail properties, good tenants, solid finances, and that history of dividend growth. All paid monthly. Could be appealing.
Definitely one profile to consider.
All right, let's switch gears. What about EPR Properties? Ticker EPR.
Right, EPR. Now, their yield is higher, right? The article says over 7%.
Over 7%. Okay, that definitely gets your attention. Also monthly payments.
Also monthly, yep.
Yeah.
So even more current income potential compared to Agree.
But usually higher yield means maybe a bit more risk. What's their focus? It's different from Agree, isn't it?
It is. EPR focuses on experiential properties.
Experiential. Okay, so that's things like cinemas, entertainment venues.
Exactly. Movie theaters, eat and play places, think Dave & Buster's type places, ski resorts, other attractions. They lease these out long term, also using net leases mostly.
Theaters, attractions, that feels a bit different from, say, grocery stores. How's that sector doing? And can EPR cover that high 7% dividend?
Yeah, experiential can definitely be more tied to the economy, but the article suggests they're bringing in enough cash. It's enough to cover that big dividend.
Okay.
They expect their payout ratio this year to be between 69% and 72% of their adjusted FFO. So similar coverage level to Agree, actually, despite the higher yield.
Interesting. So they still have a cushion. What about growth? Are they expanding?
They seem to have capacity for it. The full article mentions they can internally fund about $200 to $300 million in new investments each year.
Okay. And what does that translate to in terms of potential dividend growth?
Well, the expectation is that level of investment should drive FFO per share growth of around, say, 3% to 4% annually.
And the dividend could follow that.
That's the projection, yeah. A similar increase in the dividend each year, around that 3-4% mark.
Got it. So with EPR, the big draw is that very high yield, over 7%, paid monthly, plus the potential for steady, if maybe not spectacular, growth in a unique property sector.
That sums it up pretty well. It's a different kind of play.
Okay, on to number 3 then. STAG Industrial. Ticker is STAG.
STAG, yeah. Their yield is kind of in the middle. The article puts it at 4.5%.
4.5%, and also monthly.
Also monthly. So all three we're discussing today hit that monthly payout criteria.
Good, good. So what's STAG's niche? Industrial, obviously, from the name.
Exactly. They're in the industrial real estate space. Think warehouses, distribution centers, light manufacturing facilities. A pretty diversified portfolio within that sector.
And their strategy, how do they manage those properties?
Their plan is mostly long leases with small rent bumps built in, low single-digit escalations typically. So steady, gradually increasing income.
Industrial seems pretty hot lately with e-commerce and logistics booming. How are STAG's finances looking? Can they cover the dividend?
Yeah, the sector's definitely been strong. STAG's payout ratio is reported at 74% of FFO.
Okay, so again, leaving some cash on the table.
Quite a bit, actually, about $95 million a year in free cash flow after paying the dividend, according to the article.
Wow. And what do they do with that $95 million?
Reinvest it. They've got plans to invest $350 to $550 million this year alone to expand their industrial holdings. They also have a solid balance sheet supporting that.
That's a lot of expansion. Do they just buy any industrial building, or is there a strategy?
They look for properties with value-add potential, as the article puts it.
Value-add, meaning?
Meaning they see an opportunity to increase the property's value or income. Maybe an old lease is expiring, and they can release it at a much higher rate. Or maybe there's space to do an expansion project on the site.
Ah, okay, so they're not just collecting rent. They're actively trying to boost returns.
Right. Those higher returns from the value-add stuff helps fuel their overall growth.
Makes sense. And what about their dividend track record? Agree had that nice growth history.
STAG's is arguably even more impressive in terms of consistency. The article highlights they've increased their dividend every single year since their IPO back in 2011.
Every year since 2011. Wow, okay.
Yeah, over a decade of consecutive annual increases.
So for STAG Industrial, the key points seem to be solid 4.5% yield, monthly payments, focus on the strong industrial sector, that value-add approach, and a really consistent dividend growth history.
That's a good summary. It's another distinct profile for income investors.
Okay, so pulling it all together, Agree, EPR, STAG. What are the big common threads here besides the monthly dividends?
Well, first, they're all REITs, real estate investment trusts. And REITs have that requirement. They have to pay out most of their taxable income as dividends. That's part of their structure.
Right. That's why they often appeal to income seekers.
Exactly. Second, as we've seen, all three offer yields that are, notably higher than the broad market average right now.
And third, obviously, the monthly payout schedule.
That's the key theme today, yeah. That regular cash flow can be really helpful for people's budgeting.
And critically, it sounds like these dividends aren't just high, they seem well supported.
That's what the analysis in the Motley Fool piece suggests. They all generate enough cash flow from their properties to cover the current payouts, with room to spare.
Room they're using to grow.
Right. They're all reinvesting that leftover cash to buy more properties, expand their portfolios, and that reinvestment is what creates the potential for future FFO growth.
And future dividend increases down the line.
Precisely. It's a cycle of income generation, distribution, and reinvestment for growth.
So for you listening, if generating more passive income, maybe on a more regular monthly schedule, is something you're thinking about, well, these three companies could be worth a closer look.
They definitely offer that specific combination of yield and monthly frequency. It lines up well with typical monthly expenses for many people.
Now, just a crucial reminder before we wrap up.
Absolutely. This whole discussion, it's based on that single Motley Fool article from May 5th, 2025.
Right. And while the Fool is a respected source, this isn't investment advice from us.
Definitely not. You absolutely need to do your own research. Think about your own financial situation, how much risk you're comfortable with, your long-term goals, all that stuff.
Things change fast in the market, too. What looks good today might change tomorrow.
Exactly. Past performance is never a guarantee, so do your homework.
Okay, so just something to chew on before we wrap up. We've looked at these three REITs. Agree in retail, EPR in experiences, STAG in industrial. They're all growing in their niches. As they keep expanding, what other maybe unexpected benefits or even risks might pop up for investors who are specifically banking on that steady monthly dividend income over the long haul?
That's a great question. Sector concentration risk, economic shifts impacting tenants differently, maybe even unforeseen benefits from diversification within their niches.
Yeah, lots to think about there. Something to mull over as you explore these kinds of investments further. Thanks for joining us for this deep dive.